All right. Good morning. Today is Thursday, March 20th, 2025. Welcome to this month's Capital Markets Update and Outlook call. We are live on our website as well as all of our social media pages. So if you are with us live or if you are watching in the recording, thank you for taking some time out of your busy schedule to be here with us today. If are joining us for the very first time, my name is Eric Hagan. I am a financial advisor. I'm also president of Capital Consulting Group, or CCG. CCG consists of myself, of our chief investment officer, Tom Fox, who we are all going to hear from in just a minute or two. Financial advisors Dan Oshman and Rana Grant, as well as our client support team, John Knutson and Marilyn Westmark. Together, our goal is to help individual investors make their next financial decision, and then the one after that, a good one. One of the ways that we deliver on that commitment is through today's monthly update. Today is an opportunity for each of you to kind of look over our shoulder, get a balanced analysis of what we see, and ultimately with the goal of being a more informed investor. Today, we're going to hear from Tom Fox. Tom is going to review the positives in the markets, the headwinds, and then give us his outlook in the short term and throughout the rest of the year here. So ultimately, again, this is your opportunity to kind of look over our shoulder, get an idea of what we're seeing, what we're keeping our eyes on, and kind of what we think it means for the future. So I encourage you, if you have any questions whatsoever, you can email me directly. You can put them in the comments section if you're watching on any of the social media sites, or you're also welcome to text me as well if you have my texting number as well. And I will bring those up to Tom at the end of today's presentation. So please don't hesitate. Ask a question at any point you'd like, and I will bring those to Tom at the end of today's message. Tom spends all of his time more behind the scenes doing market research, due diligence, running different analyses, really focusing his attention on the economy and the markets. Tom has over 35 years experience building investment strategies. He has a long, impressive resume, as you can see on the screen here. And as always, I am very excited to have him here with us today. So whether you're watching here with us live or if you're watching in the recording, you are welcome and invited to post your questions. So for those of you watching in the recording, if you do post a question in the comments section, I will receive those. So don't hesitate to do that. We would love the opportunity to circle back with you. So with that, I'm going to go ahead and bring our theme for 2025 up on the screen and bring Tom onto the stage as well. So our theme for 2025 continues from 2024. The times, they are a-changin'. Tom, welcome. Thank you for being here.
Thank you, Eric. Hello, everybody. Excited to do this presentation.
We're lots going on in the markets right now.
Lots going on in the market. And this presentation is a little shorter than my long-winded presentations. But it's very impactful. So I'm excited to share with you what we're seeing and some of the actions that we've taken recently. So our outlook, here it is. We'll start off with the wall of worries. Some of these are the same as last month. I think it's been less than 30 days since we did our last one. But I title it a little different. And the first one that we're worried about, the markets are worried about, is growth scare. It appears that economic indicators are showing that things are starting to slow down and possibly could deaccelerate. This is a concern, which could obviously lead to a broader slowdown in economic growth. Another issue is that liquidity and credit market stress, declining money supply growth. A lot of that has to do with the government funding, spending money and putting it into the economy is now reversing under the new administration. So we're seeing less money in the system, and it could strain liquidity. And there's also a rise in corporate debt levels, particularly in the high yield markets. And there is increasing risk of defaults. We're seeing more and more defaults in auto loans, things like that in the lower income area. Those people that are in the lower income are really struggling right now, and that seems to be accelerating. And here's a big one: is the policy uncertainty. And so there's a lot of uncertainty. In fact, the Fed just met yesterday, and Paul asked his Fed presidents, who are all economists, how many are certain about their forecast for the year, and not one Fed president raised their hand, because there's a lot of uncertainty. And of course, it goes around the tariffs and trade policy, what will happen there. So that has impacted investor sentiment. And again, that uncertainty gauge is now at an all-time high. Another one is earning risks. Well, if the economy slows, consumer pulls back some, obviously that's going to hit earnings, and could have bring down the high expectations and bring disappointment, which could trigger a sharp decline. Now, another one is the consumer sentiment decline. The University of Michigan's index of consumer sentiment has dropped, and it's dropped to lowest point in 3 years. And this could potentially end up reducing spending and investment. So we'll see how that unfolds. There's geopolitical risks. They're always there, hard to forecast. And the last point there on that sentence is Israel and Hamas have restarted the war. Israel has, so we'll see where that all leads to. And there's a lot of instability. The U.S. is attacking the Houthis, trying to shut them down completely. Will Iran get involved? What will happen in Iran? That's still a wild card. We can talk more about that at the end. But also, market correction and volatilities increase. And we'll look at our forecast and see how well we've done so far this year. But the recent 10% decline, which makes it official, a correction did happen, can alarm investors and maybe cause the consumer to slow their spending. But we'll have to see as we move forward. Now, why should we own stocks? Well, the economy has maintained its resiliency, seeing a few cracks, but it's still overall doing quite well. The GDP growth has been steady despite headwinds. Also, the corporate earnings growth has been there. We haven't seen a big drop off in the corporate earnings, and the S&P and profits are still expected to rise. Of course, in our worry list, if that's not met, then that could end up impacting the stock market. So we have a resilient labor market. It's another positive that's been robust. We've seen a little slowing in the labor market, but nothing that's falling off a cliff. And so we'll have to see how that goes forward. And then corporate balance sheets are generally healthy. This is good. So we have strong cash flow, and dividends are rising among the dividend payers. So this is all good for stocks. Then we have the Fed is room for monetary policy easy. While the Fed remains cautious, and of course yesterday they held rates where they are, they're looking for more clarity. They're expecting two drops this year, two more rate cuts this year. The market was expecting 3.6. It dropped to 2.6 just recently. So the market is expecting a little more than what the Fed is saying they're going to do. So we'll have to see on how that unfolds. Plus, the Treasury sales, which the Fed has been lowering their level of treasuries that they own. They've been selling treasuries. They've already started slowing down that sale amount, and they could always stop selling treasuries or even go back to buying treasuries. So they have that easing potential. And overall, I would say Paul, in his address, was tilted towards dovish, which is a positive for markets. Also, market leadership is broadening. Unlike 24, when it was only a handful of stocks that did well, we see in mega cap tech stocks that drove gains pulling back, but Other stocks like value stocks, dividend stocks, and international stocks have been growing, appreciating. So there has been a definite rotation that has occurred, and that can be a sign of a continuation of a bull market. And of course, there's the long-term structural tailwinds. We've got AI, we've got clean energy, we got infrastructure that continue to fuel growth as money continually goes into those areas. Now, here's on the other side of a market correction, creates opportunity with the recent 10% in the S&P pullback. Stocks may be undervalued, presenting buying opportunities and discounted prices. Now, we have recently, which we'll talk about more, taken advantage of some big drops in growth-oriented stock areas. So we're going to look at stocks move into correction, creates opportunity. They do emerge, so we're going to look at some of those. Bond markets have outperformed the stock market this year thus far. You can see the aggregate is up 2.3%. And the treasuries were up even higher, 2.9 to 3%. The IEF that we owned and recently sold. But you can see how far some of the other areas, especially in the Magnificent Seven, dropped 14.4 during year to date as of 3/13. So you can see that some of the areas have already corrected, and we took advantage of that, and we'll talk more about that and how we've restructured the portfolio from being having a hedge in the IEF treasuries and now have gone fully invested in some of these beat up growth areas. And we'll look at a list later on of some of the things of our recent purchases. So does a value portfolio, many of you have value portfolios. You can see that year to date through 13, the S&P dropped 6.1%. It did correct. So this is not the all-time high to all-time low this year, but it showed that year to date, it dropped 6.1, but you can see having money in a balanced portfolio, 60-40, did protect you on the downside, significantly less downside, and you can see the aggregate was up 2.3. So you can see why having a balanced portfolio is a good idea for the long term. It helps psychologically to get through the ups and downs of markets. How often do corrections happen? Well, quite often, honestly. So as you can see, how often is it 5% or more? 350 times it has happened. This is over a long period of time, but you can see that markets tend to drop 5% quite often. And if you look at 10% corrections or more, you can see that it happens about once every year. Now that 5%, that happens 3.5 times a year. So it's often that you'll see in a particular year that it will drop 5%, and it's actually quite normal for a correction to occur. And severe correction, which would be 15% or more, that happens about 1 or every 2 years. And then, of course, a bear market is only 33 times, and that happens about once every 3 years. So you can see that severe corrections do happen, bear markets do happen, but it's more often than not that you'll see a moderate correction, which is 10 to 15%. And that's what we've experienced this year. Now, we just corrected where the S&P dropped over 10%. It was exceedingly fast. You can see how fast it went down. In fact, if you look historically, this correction was around the 5th, 6th fastest correction in history. You can see the circled bottom line where it says a current one was in 20 days. That's the 5th fastest. That's a fast correction. But what happens? What's happened historically when you have this fast of a correction? Well, fast corrections typically have fast recoveries. That's why one of the reasons we went into the market and sold out of the treasuries, our hedge, because fast corrections typically have fast recoveries. You can see 6 instances where this took place, and fast corrections, and you can see the reason or the cause. One was COVID, and that was the only one that was negative for the next month. You can see it was down 14.7, but that was a serious blow to the world, the economy, the global economy. That was a very serious reason. The other one was a trade war. Eisenhower had a heart attack, Korean War, Volcker shock, and an Asian financial crisis, which are pretty serious events compared to the one we recently had, which is really just the tariff and policy, which may be more about just negotiation with countries. And so what is the median recovery in 1 month later when you get a fast correction? It's 6.3%. And you can see 9.1 for 3 months, 14, almost 15% 6 months out, and to over 20% over 12 months when you have these fast corrections. Even the COVID, which was a much more serious issue, ended up 27.9 a year later. So what this tells us is that when we corrected this recently, and it happened so fast, there's great opportunity. This was one of the reasons, or one of the factors, why we went out of the treasuries and into some beaten down growth areas. Now, this is just this S&P 500. After the correction low, what happens 3 months later? Average is 13.1, 6 months, 16.4, 12 months later, 28%. These are big moves in the stock market once the correction hits bottom. We don't know if we're at the bottom, but we came off the low, and now we're starting to gain the last several days. So we'll see how it pans out. But right now, it looks like we made a very good decision to get back into fully invested position. And some of the areas that we got into, we think have tremendous upside. So let's move on to the economy. It's really sending mixed signals recently. We'll look at some of the negatives first, and then we'll go into the positives. But this is the non-farm jobs added. It's slowed in February from recent highs. This is before all the layoffs that the Fed is doing right now, the government's doing. And you can see the trend. That red line going down is showing that non-farm jobs added are starting to get lower and lower. So this is a risk. On the other side of this, the Fed is still tilted towards dovish, and they are, one of their 2 mandates is unemployment. The other one is keeping price stability. So they're watching this very closely. So it's kind of what we call a Fed put, where if the unemployment continues downward, the Fed can start lowering interest rates quite rapidly, and they have plenty of room to do that. So that's what we call the Fed put, to protect. The puts are in the call option world, are to protect the downside. So there is some protection potentially if this would continue, but we'll see where it goes from here. Nobody really knows, not even all the Fed presidents. So I can't say that I know where it's going, but we're watching it carefully. Here's another negative, is the economic surprise index. This is Citi's economic surprise, and it's turned negative. And what this is, it indicates whether all the economic data coming out is surprising to the positive side or surprising to the negative side. And you can see it's gone negative. Now, this is a warning sign that things may coming in the future may slow down. Economy may slow down, maybe employment gets worse, but what it's saying is it's something to watch. It's done it before several times. You can see in 23, And last year it also did. It went negative. So this is a indicator that moves around quite a bit, but we are watching it carefully. But it's a warning sign, so we're looking at this. Atlanta Fed surprised their GDP tracker. This is their forecast for U.S. economic growth slumped, went negative for the first quarter. You can see it had been up there in that 2 to 3% for quite a while, even over 3 for a while, but has gone negative. So this is indicating that the Atlanta Fed sees slowing growth. Now we'll see how it pans out. What the GDP does come out right now. Yesterday, the Federal Reserve said that they dropped their forecast for GDP, I think 0.4% from 2.1 to 2.6, I believe. So that they just dropped it recently, or 1.6. They just dropped that the GDP now is forecasted to be about 1.6%. For instead of over 2%. So they've already begun to adjust. It's not negative. Recession where it would have to go negative. And right now, nobody from the Fed is forecasting a recession. All right, this is the record high policy uncertainty. And this is all around the tariffs, and the potential tariffs are going on, whether it's negotiated away or it's going to stay on. We'll have to see, because tariffs could potentially raise prices and impact inflation, but we don't know yet. But you can see the uncertainty is high, and typically you get more volatility the higher the uncertainty is. So we've seen a couple jumps in the VIX, which is a volatility measure. Recently, though, it just went under 20. Which means risk on. So it has fallen just recently. And there has been some indication from our Treasury Secretary, Scott Bessent, that there may be some negotiations that may unfold into better deals with these countries, which could avoid tariffs. If that occurs, if we start to see these countries negotiate in the way that Trump wants them negotiated, this market most likely will go into another bull market surge. But we'll have to see how this unfolds. It's a lot of uncertainty currently, but that could diminish very fast. And of course, what would happen is the VIX would come down and stock prices would rise probably very quickly. All right, there are positive economic signs, which we'll look at a few of them. One is the U.S. payroll growth is still above trend. You can see the long-term trend is that green line at the bottom, and you can see the payrolls and the 3-month average of payrolls are still very decent. So they've come down, of course, from the pandemic, but they're still long-term, in a longer term, still showing that there is payroll growth, which means employees have money to spend. So we'll see where this goes. But right now, that's still holding up well. So that's a positive. And here's true-flation. It's a different take on inflation. This is more modern, more contemporary than the CPI. The CPI was built many years ago. So true-flation is a company that says theirs is more up to date and a more accurate. But what true-flation is showing is that the inflation going forward is only at 1.35%. And they think theirs is more accurate. We'll have to see where the CPI ends up going. But the last CPI print, last PPI print was lower than expected, which is all positive. Now, yesterday, Paul thinks there's risk of inflation going up slightly. So there's a tug of war right now going on. But we just saw used car prices drop like a rock recently. Used car prices are falling significantly. That was just out this week. And that's a pretty good weight in the CPI. There's typically a two-month delay, but we'll see how that impacts CPI. we're not worried about inflation right now. And we think if the tariffs get negotiated out, that of course will even bring down inflation further. So, which would be a positive for the market and for many other areas to invest in. All right. Well, the Fed may be in play to lower rates. Now, this has changed since I put this chart up, Eric. It's now at 2.6. It's highly volatile. So you could probably estimate where 2.6 is a little further down. So it's kind of come down from the peak there. But the Fed said yesterday they're still expecting 2 rate cuts this year. The market sees more. And of course, that could even jump if some of these tariffs get negotiated away. All right, international stocks, big time underperformers versus US stocks. Long term, decade, these stocks have underperformed, but recently have been helped by the dollar. So you can see the US dollar peaked in early January and has come down significantly. We think there's even more room for the dollar to decline, which has helped international stocks rally from the US point of view. So we'll see what happens here, but it could help the overseas markets and continue to outperform, especially in Europe, Germany, UK, areas like that. We could see a continuation of a rise in stock performance. For example, the IFA, which is the International Stock Index, is up over 10%. So it's done quite well. And this has helped a lot with the international stocks. We have thought about going into international stocks. We're evaluating that. But we'd like to see a pullback from where they went in such a short term. So here's our updated outlook. First, I want to go back. We haven't changed this. What we said was the economy would cool. And if you look at the last sentence, recession talks would reemerge. Consumers key. Also, we said stock market volatility would increase. We said underperforming sectors would outperform the tech area. And inflation would restart its downward trend. And then Fed would restart rate cuts, and the bonds would rally, and stocks would go negative. Well, Eric, how did we do on that forecast?
Tom, I'm going to bring up your favorite slide of today's presentation.
There we go. Yes, 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 yes. The only one that hasn't is where the Fed has started to cut rates, although they say they're going to do it 2 times this year, later this year. So the economy has started cooling. There has been, I was laughing because we did this way before, but I started seeing recession talk in all the major financial media. That has begun. And we also saw the rotation. We also saw the inflation come down in the recent CPI and PPI. And then we saw the bonds have rallied and stocks did go negative 10%. And we do think it's still going to be 0 to 10 for the year. And of course, all those took place recently. So I'm glad this presentation, wasn't a couple weeks earlier, but it did. All these began to emerge within the last month. So I'm going to pat myself on the back.
You should, Tom.
A friend of mine said a blind squirrel finds a nut every once in a while. So
I think I would give you a little bit more credit.
But I've been humbled so many times in the past. Last year was a tough year, remember, for forecasting. But this year we kind of seem to be hitting on all cylinders. We'll see how it ends up for the year. But right now, it looks like we're pretty accurate. We'll see how it unfolds as we move forward. But I've been in business a long time. I've been humbled so many times, Eric, in the past. But I'm feeling good right now.
Well, we certainly appreciate your objective analysis of everything that's going on, weighing the positives and the negatives and really taking that balanced approach. I would actually argue, I know you started the year off with a summary of 2024 saying that you were you couldn't
We're
quite say the word
the
wrong.
funds.
A little bit more credit for you. I think that what you've been saying for a little while now is happening now, and it just happened a little bit later than perhaps you were thinking. So I would pat yourself on the back for that. So we appreciate you. Now, for everybody else on the call here, it would be a great time if you have any questions for Tom. You can post it in the comments section. You can email me directly. If you have my text number, if you're an existing client and you want to text me, you can text me any questions that you may have. We love fielding your questions. If you're watching in the recording and you have any questions, by all means, submit those questions as well. And would love the opportunity to circle back with you on any questions that you may have. Just glancing at the different places here. I don't see any questions right now, Tom. But again, appreciate this this balanced view. We'll give another minute or two here for anybody to submit any questions that they may have. We do have a good group out there with us here live, so thank you for being here today, everybody. Real quick, looking later on today, I will have a summary of today's presentation. So I've had some questions about the summary. We do produce a two-page summary of today's presentation. I'll have that on the website here this afternoon. So you can just click on that button. You can get that summary if you'd like it. And then also a button here where you can ask a question directly on the website as well. Looking ahead, tentatively mark your calendar for Thursday, April 17th for our next monthly update. So a lot of stuff happening between now and that date. So we'll see if Tom's presentation changes between now and then and just how much. We are planning to do an in-person luncheon that day. It is tentatively scheduled right now, so that may change. Any changes we'll get on the website. Also, for those of you that want to pay attention a little bit more often than these monthly updates, I do a short 3 to 5 minute update on things that are happening. I start my week off with that. So Monday mornings, 9 a.m. Central, live on our website, all the different social media pages. So I invite you to join me on those. And then 2 o'clock Monday afternoon, I send out a summary email and a link pointing back to that recording. So if you're not getting that email and you would like it, you may subscribe at our website as well. Just looking at emails here, Tom, see if we have any questions that came in. I've got some comments that they love the green check slide. We'll put that one back up there. But no questions. Let me check the social media again. No questions. So, all right. I'm going to say that we'll call that a wonderful presentation here today. So with everything going on, I can't stress enough how valuable these monthly updates are. All of my client conversations the past week or two have had a lot more confidence, I think, particularly those that do pay attention to this monthly update. So we appreciate you. Thank you very much for this. Any closing thoughts, Tom?
No, but we'll see how things unfold here. And if the tariffs potential is negotiated away, you will see a market rally. It could be very quick, very fast, but we are positioned properly right now for the markets to recover some of those losses, especially in the areas that we recently purchased. We bought areas that were pretty beat up, and they all have great revenue, great earnings, these areas that we went into. So they're very strong companies that undergird what we went into, and they just were overvalued. Now they became inexpensive. So we're excited to be positioned where we are, especially several of them that were down more than 20%. So we think there's great opportunity for recovery. If the market doesn't go up or it goes down more a little bit, I think we're in very good shape because we already bought into some areas that have been discounted. So we feel very good about our positioning right now.
Excellent. Excellent. Thank you again, Tom. Appreciate you. Thank you, everybody who attended live today. We had a great group on here, so thank you for taking the time out of your busy schedule to be here with us. That concludes our monthly capital markets update and outlook call for March 2025. Hope you all have a wonderful rest of your day. Bye, everybody.